Hello and welcome again. This is Islam Mahmoud. I will be your lecturer today. You should be now seeing the risk warning written in both Arabic and English. The risk warning state that trading in forex CFDs and other derivatives is highly speculative and carries a high level of risk. It's possible to lose all your capital, and these products may not be suitable for everyone. You should ensure that you understand the risk involved, and you can seek independent advice if necessary. Okay, so today we will speak about the indicators. We will speak about technical analysis, especially the indicators we can use to predict the market moves. First of all, we need to identify the word. What is a technical analysis, or what we really mean when we use the term technical analysis. So before beginning the study of actual techniques and tools used in technical analysis, it's necessary first to define what technical analysis is, to discuss the philosophical premise on which it's based. So technical analysis in financial market, we mean by this term, the study of past market data, primary price action to forecast the future price movements. So there is key principles in the technical analysis studies. Uh, the first principle is that price action discounts everything. That you only need to read the price action to know what you need to know. So all information, whether public or private, is reflected in the price. So the technician believes that anything that can possibly affect the price fundamentally or politically, psychologically, or otherwise is already reflected in the price. So the market follows. Therefore, the study of price action is all that is required. The second key principle for technical analysis studies is the price moves in trends. So price tend to move in a general direction, up, down, sideways until the trend reverse. So the concept of trend is essential to the technical approach. The whole purpose of charting or price action of market is to identify the trend early so we can use this direction of the trend to our favor. In fact, most of the techniques used in the approach is trend following in nature, meaning that there is intention is to identify and follow the existing trend. Okay, so this is a trend as we see it in the market. So the uptrend is higher highs and higher lows. If you can see, let me use this pointer. Higher highs and higher lows. This is an uptrend. So if we have a lower highs and lower lows, this is the downtrend. And if we have the highs and lows in the same uh, line or the same price, so we call this a round or a range market. Okay, so this is the trends we are trying to figure out. So is it an uptrend or downtrend or range market? So first, we saw that price action discount everything. Second, we know that price moving trend. And the third key principle is history repeat itself. That means that market moves in cycles and patterns tend to repeat over time. So this is the three key principles in the technical analysis approach, and based on that we will now move to the technical indicators. What is a technical indicator? A technical indicator is a mathematical pattern derived from historical data used by the technical traders or investors to predict the future price trends and make trading decisions. So what we saw in the market, we will just use some calculations, some mathematics to turn this to something that we can use to predict the price move. This is the technical indicators, and today we will discuss the most important and the mostly used indicators. But before we go on that, we need to know that there is types of indicators. Two types, basically two types of technical indicators. There is an overlay which is a technical indicator that use the same scale as price. We draw it at the same place. So they are plotted over the top of the price on a stock or a chart of currency or metal. So example of this will be like the moving average and Bollinger Bands. We will go to discuss this moving average and Bollinger Bands just in some slides. And the second type of indicators is oscillators, which is technical indicator that oscillate between local minimum and maximum. They are plotted either above or below the price, mainly below the price. Examples of this will be the stochastic and the MACD and the RSI. We will go on and see all of these, but let's start exploring the moving averages. This is the first thing, the first indicator we will use today. So what is a moving average? It sums up the data points of financial security or currency or share. It sums the data points over a specific time and divide the total by the number of data points to arrive at an average. So basically moving average are calculating to identify the trend direction of the stock or a currency. Also, it can be used to determine the support and resistance level. It's a trend following or lagging indicator because it's based on past prices, meaning that the price will lead and the indicator will follow. So the longer the period for the moving average, the greater the lag. A 200-day moving average will have a much greater degree of lag than a 20-day moving because it contains price over 200 days or 50 days, and 200-day moving average figures are widely followed. The 200 and the 50 and also the 100 and also the 21, these are followed by most of the traders, and it gave a very important trading signals for traders, especially on the daily market for popular shares like Apple, popular metals like gold, popular currency pairs like euro, dollar, and so on. So let's see an example. This is the 50-day simple moving average for the gold. I say simple because there is other exponential moving average. It's the same concept, but it give more weight to the recent prices. But mostly we can use the simple moving average. So here you can see this is the daily, the 4-hour chart or the daily chart for the gold, and this is the 50-day moving average. You can see here on the price above the moving average, we are in an uptrend. If we break the moving average, we consider this reverse on the trend, and we consider this going back to a downtrend. You can see here it was down for a very long time, and then it broke it. So from this moment, we can consider uptrend again. So this is the most effective and simple way to use the moving average to know the trend and also support and resistance level of the currency or the share. So let's move on to another indicator, which is the RSI, the Relative Strength Index. So the RSI is a momentum indicator used in technical analysis to measure the speed and the overbuying and overselling of the share or the currency. The RSI is displayed as an oscillator, so it's down the chart. It's not in the same as the moving average, not in the price, but it has a layer by itself down of the chart. So it has a scale of 0 to 100. When we see the scale over 70, we consider this over bought. When we see it under 30, we consider this over sold, or the vice versa. When we see it in the go which is going down, this is oversold. So under 3, under 30, it's oversold, and over 70, it's overbought. This indicator was developed by G. Wallace Wilder and introduced in his 1978 book, New Concept in Technical Trading System. Let's have some example of RSI to consider. See here, this is how you can see it. 30, when we have this 30, so here in this area the price is going down for a very long time, so we consider this an oversold area. The price was sold, the price was going down for a very long time. So when we see it's moving up from the 30 again, we consider this as a buying signal. Not by itself, we should use indicators, combine them by other indicators and also by other technical analysis tools. Here in the 70, the price was moving up. It was going for a very long time. When it break the 70 point, this is an overbought area. The price was moving up, meaning there is a buying power in the market. So at this point, the buying power is fading and the price is likely to go down. We don't say 100%. You always treat the technical indicators and any technical tools as a guide, not an exact science. So likely, we will not say 100%, but likely the price will go down from this 70 area, okay? So we can see here the RSI in real chart. This is the dollar yen daily chart. You can see here, this line is the 30 and this is the 70. You can see here 70 and 30. So most of the time it will stay over the 70 for some time, because here this is a very strong uptrend, as you can see here. But at some point when it break the 70, it started to go down for some time. You can use this with some filter, like, you know, following the trend, taking only the signals that follow the trend. So we have now an uptrend, so we only look for buying opportunity like this one, breaking the 30 going up. So this is a buying opportunity. Maybe here we wouldn't sell, but at least we will wait for some time. We will not buy because this is over buying area. And you can see here it was consolidating for some time before it go on again. So you can take this with the trend as a filter to decrease the losing signals. Let's go to other indicator, which is the MACD, or MACD as most traders call it. MACD stand for Moving Average Convergence Divergence. So it's a technical indicator to help investor identify price trend, measure the trend momentum, and identify the market entry point for buying or selling. The MACD is a trend following momentum that show the relationship between two exponential moving average of a security or a share or a currency pair. It was developed in 1970s by Gerald Appiel. So the MACD line is calculating by subtracting the 26-period exponential moving average from the 12-period exponential moving average. The calculation creates the MACD line. A 9-day EMA of the MACD line is called the signal line. This is plotted on top of the MACD line, which can function as a trigger to buy or sell signals. So you don't need to memorize all this. It's calculated automatically in your trading platform. So the MACD indicator work this way, and it can be used like buying, selling opportunities, as we will see in some time. And it also can give you divergence of the market, as I will just show you right now. Okay, let's start by seeing the MACD in work. This is the gold 4 hours chart. You can see here this area. This is the MACD. We have this bars, which is, you know, giving you like the volume of the trend, and we have this line, which is giving you the direction. When it break the zero, you see this zero line. You can see it here from here. Yeah, when we break the zero line down, it should be a selling signal, or at least if you're in an uptrend, you shouldn't buy from here, because we can have a reversal of the trend. Okay, this is one way of using MACD. You can use it like here, giving you buying selling signal. When it break the zero line down, it's sell, and from zero from down to up, it's a buying signal. This is a way of using the MACD, and also this is the divergence of the MACD. Let me give you some real-time example of the divergence. This was the dollar yen. It has a divergence. The meaning of a divergence is here we have a downtrend. Okay, you can see the move between these two red lines. It's going down, correct? It's going down, lower lows as we expect in a downtrend. See, at the same momentum is not moving down, is not moving, making lower lows. It's actually making a higher lows. You can see here this low and this low. Now the price here is making lower lows, but here the momentum is making higher lows. We call this divergence, meaning that the price is still moving in the trend, but moving with decreasing in the momentum. It's like a car, you know, when you are speeding with a car, and for some reason you want to stop to buy some drink or to take a turn. You will first decrease the speed. You will use the brake to decrease your speed, and then you will start to move your direction to the new direction. This is actually what the MACD is telling us in the divergence, that the price is taking some break. The acceleration, the momentum of the move is now slower. So this means there is a very strong chance that the price will change the direction. As I mentioned in the previous indicators, you don't take this as a science, as 100%. Everything here is an art. You use this, you use your experience, you use your other fundamental and technical tools to make a decision, and always keep in mind that there is a risk in every trade. So this is a very strong signal for me personally. When I see this, I feel that I have a very strong reversal coming, or at least the trend will not continue at the same momentum. So we will go to another indicator, which is the stochastic oscillator. It's a momentum indicator comparing the particular closing price of a security or a share or a currency pair to a range of its price over a certain period. The sensitivity of the oscillator to market movement is reducible by adjusting that time or by taking a moving average of the result. It's used to generate overbought and oversold trading signals utilizing 0 to 100, just like the RSI. We will come in a minute to compare the stochastic to RSI. So it measures the momentum of an asset to determine trend and predict the reversal. Stochastic have a scale from 0 to 100. It measures above 80, indicate that the asset is overbought, and the measure if it's below 20, it indicate the asset is oversold. So the stochastic charting generally consists of two lines. Okay, one reflecting the actual value of the oscillator for each session, and one reflecting its 3-day simple moving average, because price is to follow momentum, the intersection of these two lines is considered to be a signal that a reversal may be in work, as it indicates a large shift in momentum from day to day or from candle to candle. So a divergence between the stochastic oscillator and the trending price action is also seen as an important reversal signal. For example, when a bearish trend reach a new lower low, but the oscillator print a higher low, it may be an indicator that the peers are exhausting their momentum and the bullish reversal is brewing. This is as the same example I was just explaining in the MACD. So we have a relationship between RSI and the stochastic. They are both price momentum oscillators that are widely used in technical analysis. While often used in tandem, they each have different underlying theories and methods. The stochastic oscillator is predicted on the assumption that closing prices should move in the same direction as the current trend. This is other way of saying higher highs and higher lows. Meanwhile, the RSI track overbought and oversold levels by measuring the velocity of price movement. In other words, the RSI was designed to measure the speed of price movement, while the stochastic formula works best in consistent trading range. So in general, the RSI is more useful during trending markets, and the stochastic is more in a sideway or range market. So if you are in a range market, you will use stochastic. This is my advice. And if you are in a trending market, use the RSI. They both give the same signal, but stochastic work better in range. So here you can see the gold daily chart. Stochastic actually sometimes you feel it's faster than the price. That's why it's more useful in the range, not in the trending market. Because in a trending market, it can give you like this overbought signal, while the trend is still very strong. Okay, RSI, we will wait for it to break down, but from here it's giving this signal. When this blue line cross the red line, it should be a selling signal. But as I always mention, don't take signals against the trend. If you take it, okay, it's your call, but take it with cautious, because sometimes the trend will just continue, even if you are in an oversold or overbought area. So now I will be happy to have to receive your questions if you have any. And while I do so, let me go to the market and make some actual examples. Okay, someone is asking about gold. Okay, this is gold. We have here the stochastic. This is the daily chart. Okay, gold now is around 2,581. If we go to the 1 hour chart, if you can see here, see, this is a very strong signal from the stochastic here. See, when the move was very down, this is after the news yesterday of the Fed cutting rates. The Fed cut the interest rate from 5.5 to 5% only. So this is 50 points cut. The market was predicting from 25 to 50. So the Fed gave the market the max rate cut it was predicting. That's why the gold went like crazy up and down. So here you see the stochastic gave you this indicator to buy from here. You can use this. Actually, let me show you how to do it. Indicators, you click on insert indicator oscillator. From here you can see stochastic, already have it. If you want to add also RSI, you'll see it have the name relative strength index RSI. You can keep the default setup, and this you will see here. See the difference. The stochastic moved very fast to the uptrend, while the RSI took more time. That's why we use the RSI more in the trending market, while we use the stochastic in the range market. Also, let me show you the moving average here. Let's use the 21 moving average. This will be very fast one. Daily, you can see here it's working as support resistance. Here the price, when it break it go and retest it again, and from this moment it's above the moving average. This is the daily. You can change this to from 21 to 200. This is commonly used. Okay, daily. Let's zoom out to show you here. Okay, most traders use the 200 and also the 100. So you should see where the 200 is, even if you are not using it. Let's see where is the 100 now. See, very near. The prices of gold are above the 100 moving average for some time, also the 50. So it's now much near the 21. See, now you understand the idea of moving average. The more you decrease the number, the more movement you will have on the moving average, and the more you increase the number, the more it will be lagging of the price. So if there is any more question, I will now. Okay, I think it's everything is fine now. We always do this webinars on Thursday 6 p.m. Dubai time, so feel free to it's free, so please join us in the upcoming webinars, and also we'll have a recording of this session. If you missed anything, you will have it in our YouTube channel and also our website. If there is no more question, I will now be ending this. Okay, so please join us in the upcoming webinar, and now I will be ending this session. Thank you for your time, and goodbye.